What is the Biden administration most likely to bring? Is it going to be the appearance of calm, but a deterioration of America's strength in this relationship?
Well, I think there's only so much that policymakers can do to reduce their constraints. And I think appointing Tony Blinken is a good step towards mitigating some of the constraints that the Biden administration is going to face. But if you're a C-suite executive in a multinational corporation right now, you have to understand that the deterioration in relationship is structural, and that it's going to be difficult for the Biden administration to play the two-level game between Beijing and their domestic opposition.
The reason why I think people are talking about this so much right now is we have a lot of people out there saying you absolutely want to own stocks with China exposure right now. It's going to be a friendlier relationship between these two countries. There's not going to be any risk of, business being undermined by some of our geopolitical objectives. I mean, do you think that's right, that people can kind of comfortably own, whether it's the handbag names or Estee Lauder or the big, manufacturing companies, that those who rely on doing business with China should expect to do quite well?
So both yes and no, unfortunately. Yes, there is a structural impediment and constraint to further trade war blowing up. I don't think that, in 2012, it was time to predict a deterioration in a relationship. But we're 8 years removed from that. That forecast came true. We cannot simply extrapolate it linearly. I think that there are constraints on both China and the U.S. in terms of making the trade relationship worse. However, on a short-term 12-month horizon, what's going to matter more for that basket of stocks is what's happening domestically. And it's pretty clear that Chinese policymakers are trying to signal to us through multiple avenues that they intend to deleverage the economy and that they do not expect to continue stimulating. In fact, very similar to the report Elon made earlier about what's happening in the U.S.
So if that's the case, though, I mean, China is still the economy that's emerging first, fastest, and arguably strongest from the global pandemic. I mean, that puts them in a pretty powerful position to dictate the terms of commerce over the next few years, doesn't it?
Yes, but the stock market has already priced that in. So if you look at the performance of Chinese stocks this year, it's been stellar. But notice that CSI 300, for example, has not really done that much since Biden was elected. It's only up about 2%. And I think that that's, telling us, look, Chinese stocks have already done what they were going to do. They've already priced in this advantage that China has in resolving COVID first. Going forward, there's going to be more of a range-bound market in terms of Chinese equities, not so much because of a U.S. China relationship, but more because policymakers domestically are just focusing on antitrust. They're going after their big tech, so there's a huge stroke of pen risk. They're setting 3 red lines on the real estate and property developers. And also, they've introduced some volatility in the sort of corporate bond market, onshore corporate bond market, that's likely to lead to further agita in the equity market as well.
Well, and you've just given us a couple of ideas there, maybe about what parts of the Chinese market to avoid. What would you say is best positioned? So just to kind of put a point on that, where would you say is kind of well positioned for this era that we're heading into? And are there any other places that you would warn investors about?
So first of all, what I would say is that in terms of the Chinese market, definitely consumer plays are going to do well. Anything that the Chinese policymakers have sort of introduced tailwinds to, so innovation, tech. We've seen, for example, the Chinese, Tesla challenger, NIO, do extremely well. Those kind of plays are probably going to do well over the next 12 months, regardless of the deleveraging points that I've raised. In terms of the broader implications of Chinese deleveraging, if Chinese total social financing, so their sort of broad measure of credit, drops from the current 13.5% annual growth to something like 10%, East Asia EM plays are likely not going to do well. So whether it's South Korean market, Taiwanese, broader sort of EM Asia is going to struggle if China takes a step back. And the other question that I have is, what is the interplay of Chinese deleveraging in a world where next year we also have less fiscal stimulus in the U.S., at least less than the market expected? Mm-hmm. What does that mean for the U.S. dollar? That's going to be a very difficult question to answer. But I think, and look, I'm a bear on the U.S. dollar over the next decade. I think we're in a bear market. But I think over the next 6 months, dollar could catch a bid and catch some of these reflation trades off guard. And although I'm bullish over the next cycle, bullish commodities, EM, all that stuff, if you're a long-term institutional investor, I think it makes sense. over the next 6 months, I think some of these reflation trades we've all gotten really addicted to might suffer.
Shepard Smith here. Thanks for watching CNBC on YouTube.